Palantir and SoFi stock. What a historic 3-month run it has been for these two stocks. SoFi stock is now up 114%. Palantir stock is up 96% in the past 3 months. Absolutely historic run on a 1-year basis. Palantir stock's up 226%. SoFi stock is now up 126% just in the past year. Absolutely historic run for both these stocks. Palantir, I want to talk about some huge changes that are going on in Palantir. A lot of people are wondering, a lot of people have been predicting the stock is going to crash, especially in the last couple of weeks. I noticed a lot of people predicting Palantir is going to crash, short Palantir, buy puts, those sorts of things. We're going to talk about what's going to likely transpire here in Palantir stock in the short term. Additionally, we're going to speak about in this video, I think it's an important subject we cover, when's the next 2x for Palantir, right? Obviously, the valuation's gotten raised immensely. I'm going to take you through several different scenarios here and kind of know what I expect in regards to the next double up of Palantir and taking the stock to $120 plus, okay? We're also going to speak about SoFi in this video, where this stock is headed short term. And additionally, when's the next 2x for SoFi stock? These two stocks actually set up very differently in the short term and in the long term. So we're going to speak about that in this video here today. And then once we get through that, I want to go ahead and react to 2 videos specific in this video here today. First one up here is Fast Money Traders talk about divergence in tech trade in the second half of the year. I'm really looking forward to reacting to that one. And then I want to react to this one. The market is saying it's incrementally more confident in the growth outlook, says Goldman Sachs. So looking forward to reacting to that one here today as well. I appreciate everybody joining me as always. It's one thing and one thing only I ask from you guys. You know what it is. It's in my garage. I got a sign. It says it right there. Smash the like button. That's all I need. I hope you guys appreciate me recording this on a Sunday night for you guys here today. And all I need from return is one smash of that like button. If you want to be subscribed to the channel, feel free to subscribe. It's free to do so. Additionally, you'll be flipping my flapjacks, folks. We're only a few days away from the Black Friday sale for 1000xstocks.com. That is going to be full access to everything in 1000xstocks.com. The education portion, the comparison feature, the charts feature, the valuation metric, all that good stuff, okay? Pin comment down there to enter in your info for the deal. Now, I've been letting folks know, all you have to enter in is your name and your email to receive the deal that day, but you might want to consider putting in your phone number because you know your inbox is going to be flooded with spam emails on Black Friday from companies that you don't even really care about, because guess what? It's Black Friday and every company you possibly ever signed up for in your life is going to send you an email that day. So if you want to make sure you for sure get the deal, because it's only 1-day sale and that's it. And when it's over, it's over. So if you want to for sure make sure you get the deal, you might want to have that text over, okay? So let's get into this. Palantir stock is set to soar after November 26. Guess what today is? It's almost November 26. Now, how do I feel about this? Well, we got to understand, very important here, we got to understand why so many people are predicting that Palantir stock is going to go on another epic beast run here. And the reason people are now predicting that is because of this. Palantir is leaving the New York Stock Exchange for the Nasdaq. Now, the Nasdaq, it's really the place you want to be nowadays. Honestly, it gives you, in my personal opinion, it gives you a lot more, let's call it investor interest out there when you're on the Nasdaq. You get more publicity being on the Nasdaq than you do in the NYSE. At least my opinion personally is that, right? If I had a company like, 1000xstocks.com and I was going to take it public, New York Stock Exchange or Nasdaq, honestly, nowadays, I would go Nasdaq. Maybe 20 years ago it would have been different, but nowadays, I honestly feel like Nasdaq's a better route to go, right? So Palantir stock gaining Friday on plans to switch to listing from the New York or to the Nasdaq from the New York Stock Exchange. Investors seem to be hoping the software company will gain from the stock getting added to the Nasdaq 100, which is a QQQ, which is very widely invested. I know a lot of investors that will buy the Qs, no different than a lot of folks buy the S&P 500 index fund. There's a lot of investors that view the Qs as a better reward profile over the next 10, 20 years. So a lot of people that have a further time horizon, let's say you're in your 20s, 30s, 40s, a lot of those folks might rather just put money in the Qs, it's called QQQ, which is the NASDAQ 100, rather than put money in an S&P 500 index fund. And they think they'll get much better gains. And I got to be quite honest with you guys, if, obviously an individual stock picker, I'd much rather pick individual stocks and pick the best stocks in the Qs or the S&P 500 or whatever to invest in, right? But if you told me I had to invest in either the QQQ, right, or I had to invest in the S&P 500. To be quite frank with you guys, I would invest in the Qs over the S&P 500. Look at the 5-year returns for the Qs versus S&P 500. You're talking about 158% for the Qs versus 97% for the S&P 500. But let's back it up further. Let's take it back to, why don't we take it back to about 10 years? That would be good. Well, it looks like, I don't know why TradingView's chart. Oh, maybe it's because WTI is here. Maybe that's what I need to get rid of. Oh, is WTI on it? Let me get rid of, let's go to, I don't know, Tesla. Okay, and we'll take it back here. Well, let's go to Apple, because then we can take it back way far. So let's check out a 10-year chart here of the Qs versus the S&P 500. So right about here, so 10-year, you're looking at about 280% gains for the Qs versus 123% for the S&P 500. So the moral of the story is, if I had to guess what outperforms what over the next 10 years, and you forced me to invest, as I said, Jeremy, you're not allowed to buy individual stocks, only some sort of index or ETF or something like that, I would go the Qs over the S&P 500 any day of the week if I had a long time horizon. Now, if I had a short time horizon, I might be more inclined with S&P 500 if I was later in life, something like that. But I'm like, no, I would definitely go Qs over that. So this is a huge moment for Palantir, and there's going to be massive forced buying coming into Palantir stock in the short term. And it's just, there's not a debate around that, to be quite frank. There's no debating whether there's going to be a bunch of money flooding into Palantir. It's basically just, pretty much factual. At this point in time, there's going to be a lot of money flooding into Palantir stock in the short term, right? And honestly, over the longer term as well, when it's in the Qs, especially getting that it's going to go in as likely, it's going to go in somewhere around the 30th biggest stock in the Qs, which is a whole other big deal, right? Now, additionally, this is very important, this next part I show you here. I don't know how many of you guys watch my main channel, which is called Financial Education. I'm sure, at least 50% of you guys here on the Reaction channel, you know about my main channel, Financial Education, right? And I did a video 4 days ago on the channel called Stock Market Melt-Up 2.0 is Coming, Prepare Now, right? And in that video, what was one of the main points I made was it's, a lot of times when the market's performing very good, which guess what? It's been a great year in the market. It's been a great year. Many times fund managers run into situations where they're significantly underperforming the S&P 500 and the Nasdaq, right? And a lot of these fund managers, their benchmark, which is the thing they kind of compare themselves to, and when they put out their end of year investment report to their investors, they say, here's how we did versus S&P 500. If you are showing you got, let's say, a 10% return and the S&P 500 got a 25% return, you look really bad to your investors. And any investor that invests in your fund or whatever, right? Let's say you got a hedge fund, they're going to be looking at you and like, hey, why am I paying you a 2 and 20 to get 10% when I could have just been the S&P 500, got 25%, right? So what happens is fund managers start having to play catch up to the market. Now, additionally, when you had a really good year in the market, guess what people don't want to do? They don't really want to sell stocks. And why would they not? Well, because you sell stocks now, you go ahead and pay gains on that in a few months from now. Versus wait till the first quarter of the year, of next year, right? And then go ahead and sell some stocks if you want to sell some stocks, right? And take profits then. And then you can worry about your taxes over a year from now. So the moral of the story is, if you're going to be a fund manager and you got to play catch up to the market, where are you going to look? Guess where you're going to look? I just showed you where you're going to look. You're going to look to the Qs. That's where you're going to look if you're a fund manager. If you're going to look individual stocks, then you're probably going to be looking at Nvidia here over this next, like if you told me I had to play catch up to S&P 500, I would be like, okay, what am I going to do over the next 5 weeks? I'm going to probably load up on Nvidia. I'm going to probably load up on Palantir. I'm going to probably load up on the Qs in general, those sorts of things, right? And if you're loading up on the Qs, you're going to be loading up on Palantir, right? So that's something to kind of keep in mind there. You're going to be loading up on the stocks that are the hot ones that are likely to try to get that alpha before end of year to try to look better to your investors, right? So this is something that's very, very important for everybody to keep in mind here, and why Palantir could still be, honestly looking good into the year end. I think after year end, then we'll see. Then we'll see what happens after that. But I got to say, the setup's decent here into year end. When you talk about getting in the Nasdaq, getting in the Qs, when you talk about fund managers likely having to play catch up, when you talk about a lot of investors aren't going to want to take profits. And also remember, in Palantir stock, a lot of retail investors in that, right? A lot of retail investors don't want to take any profits on Palantir because they believe it's going to be a $500 billion market cap, a $1 trillion market cap. And so Palantir being a $100-something billion market cap, they're like, why would I sell now? So that's just more thought there, right? Now, let me run you through, because now people are kind of thinking about, when's the next time the stock doubles and goes to 120 plus? Well, let me show you exactly when that's going to be, okay? So what we're looking at here, this is a feature I have on 1000xstocks.com. This is my favorite feature we have on 1000x. We have a lot of great features on there, but this is my favorite. And this is our projections feature. And so what it basically does is it takes kind of what analysts are expecting for the current year we're in, which is 2024, as far as net income expectations, revenue expectations, right? But then I can plug in my own custom revenue growth, net income growth I'm expecting for the company, PE ratios, and then it will spit me out what the stock price should likely be, somewhere around there, right? So this is kind of an ultra bull case for Palantir. This is what some investors believe is actually going to happen. But I would call it, my personal opinion, this is a very ultra bullish case. Basically, investors now are thinking, because Palantir's growth rate has been accelerating. Investors, a lot of investors are starting to believe Palantir's going to get to a 40% growth rate. 40%. So let's say they get to 40%, and let's say they can hold that for the next 4 years, right? 2025 through 2028, 40% a year revenue growth. If they do that, then I think net income growth is 60% is in the bag if they were to have revenue growth of 40% on average, because the net income is going to be far outstripping the revenue growth of this company, because so much more of that dollars coming in is going to hit bottom line now at this point in time, right? So if they're doing 40% a year revenue growth, they're doing 60% bottom line, in my opinion, right? Which puts them at net income margins of 36% in 2028. But this is important. If you've got a company growing 40% top line on average in the software space, a SaaS type company like Palantir would be considered more of a SaaS type company, right? And you've got them growing net income 60% a year, you're going to command easily a 100 to a 150 P ratio on that company. Now, if you're talking about a 100 to 150 P ratio on a 40% top line grower and a 60% bottom line, then you're looking at likely 2027 being the year when the stock crosses 120 plus, and you get the next double on the stock. So you got to get through this year, next year, and then at some point in 2027, you essentially hit that next double, right? Once again, I wouldn't bank on that case, but it's a case some folks are starting to run to. This is a little tamed down version of that case there. This is what I would consider kind of a bull case around Palantir. This scenario is they grow 30% revenue on average per year. Now, keep in mind, they just hit 30% and they've been showing acceleration. So it's potential they hit higher than 30% in the short term, but let's just average it out to 30% a year for the next 4 years, right? If they do that, they're probably hitting about 50% net income growth, right? Which puts them around 37% net income margins in 2028. If you've got a company growing at 30% top line, 50% bottom line, more of a SaaS related company, and 80 to a 120 P ratio is very fair given those sorts of growth rates, right? Which means 2028 is when you get your next double for the stock. Now, let me take you through what I actually expect personally for Palantir. As a shareholders company for the last couple of years now, somebody's done very well in the stock. Let me show you what I'm expecting. This is what I'm personally expecting for Palantir at this point in time. So this is my base case for Palantir. I expect the company to grow 37% in 2025. I think they're going to continue to accelerate growth here in the short term, meaning the next year. And then I think at some point in time, back half of next year or into 2026, I think that's when you start to actually have some deceleration of the growth rate. Keep in mind, deceleration of the growth rate for anybody that's a newer investor of the market that's watching this, that doesn't mean that the company goes negative in regards to their revenue. That just means the rate of growth slows substantially, right? So I've been growing revenue 37% in 2025, 33% revenue growth in 2026, 30% in 2027, and 27% in 2028. Now, I would have them growing 60% bottom line in 2025, 50% in 2026, 45% in 2027, and 40% in 2028. My scenario has them getting to 34% net income margins in 2028, which I don't think is crazy. I don't think that's crazy. Look at a lot of, more developed SaaS companies and look at their net income margins, and you'll be like, hey, that's actually doable for Palantir here, right? Now, if we're talking about this, the P ratio is going to command, basically the P ratio that Palantir will be able to command will go down over the coming years, right? We're probably my guess is this year and next year, we're probably in peak P ratio land for Palantir in regards to what type of P ratio Palantir commands, okay? And I think that will slowly go down over the coming years. So in 2028, if they're growing 27% top line, 40% bottom line, as more of a SaaS-related company, 80 to 100 PE is pretty fair for a company that has those sorts of growth rates in this space, which means actually in my base case here, 2028 should be a year where the stock likely hits that 120 plus level. So that would be a double up there. So the moral of the story is, if you're talking about the next double for Palantir and the stock goes well over 120, at the earliest, you're probably looking 2027-ish, right? Somewhere around there. I think realistically, you're probably looking at more toward 2028. That's my guess. Now, there's also another scenario where, the company stock just continues to go crazy, even if they're not hitting these sorts of growth rates. And that's always a potential. But I like to think about it in terms of like, what would be a fair PE for the stock, given growth rates, given the sector they're in. So that's kind of the way I think about it, right? I mean, technically, Palantir could be $120 today. It could be $1,000 today. Like, any stock could technically trade at any price, but we got to be somewhat realistic about this, right? So that's kind of my thoughts here. And that's why the further the stock pushes into year end, the tougher the setup is for major gains over the coming years, right? So that's just, a little food for thought in regards to that, in regards to Palantir, right? Now, what about SoFi? So here's the deal. SoFi honestly could keep rolling short term pretty easily. And the reason being is if you continue to have this momentum in the Russell 2000, right? Now, SoFi is a much bigger market cap than like the Russell 2000 stocks, but it kind of gets put into a lot of the same category as like a small cap stock because SoFi in the banking space is actually a small little company. Even in the fintech space, they're a small little company. If you compare them against fintech giants, if you compare them against banking giants, SoFi is like a little newborn in the game compared to those big giants in regards to the numbers SoFi does versus those companies, right? So if the Russell keeps rolling, you get the Nasdaq to keep rolling, you get the end of year rally, you get retail momentum to continue to be there, which it seems to be there in regards to retail momentum, right? And you just get that end of year kind of market move up, Santa Claus rally. SoFi could easily continue to roll here in the short term. And, so I'd be careful trying to bank that SoFi stock's going to crash anytime soon, just to be quite frank with you. Now, when's the next double up of the stock? When does a stock go to, $30 plus? Well, here's what I believe. So SoFi's last quarter, it was an A minus income statement. Phenomenal numbers from SoFi. Listen, if this company keeps coming in with these sorts of reports, an A minus grade, A plus grade, something with an A in front of it, I think this stock's 30 plus within 24 months. If they keep coming in, next quarter's another A grade, next quarter's another A grade, it could be within 12 months. So that's something to kind of keep in mind here in regards to SoFi. Like this one's momentum could continue to be ridiculous for the next 1 to 2 years if they keep coming in with these sorts of great reports. Now, if they falter, that's going to completely change the kind of way people view SoFi. Like if all of a sudden they come in with a C, let's say next report's another banger, and then they come in with like a C grade income statement, right? Well, then people's opinions will change and sour very quickly in regards to SoFi. But dude, I'm telling you, if they keep coming in with these A grades, put it to sleep. Like, we're going 30 plus here, in not too distant in the future. So that's kind of my views in regards to that subject. I hope you guys enjoyed that part. My views all around Palantir and SoFi there, okay? Let's go ahead and react to some videos. What do you say?
Two pillars of the tech trade, software and semi-stocks, heading in different directions in this second half of the year. The IGV ETF up. It sounds like I give up, right? That's what it looks like.
You never give up.
I give up.
It's not what you do.
Up 22% since the start of July, while the SMH chip ETF has gotten crunched, down more than 6%. Top software names making major moves higher in that time. Oracle, ServiceNow, Salesforce, Snowflake, all up double digits, while big chip stocks continue to trade lower. Lam Research, AMAT, Micron, Qualcomm down 10% or more. So will the second half separation in tech continue into the year end? Let's get to that. But why don't we begin with your reflections on the fact that here we go again, another Dow record high, the S&P 5969, close to 6,000. Then lead me to the tech.
No stopping it.
There's no stopping.
Now, if I had said Tyler Matheson, there's going to be a headline this week that Russia fired ICBMs into the Ukraine. What's going to happen to the market? And you'd be, if you had said it to me, I'd be like, well, the S&P's easily down 100 handles.
Yep.
The VIX is north of 25. Gold's up $100. 10-year yields are probably significantly lower on a flight to quality. None of that happened. So I guess if nothing else, that just shows you the resilience of the broader market and passive investment.
Listen, this battle, conflict, whatever you want to call it, it's been going on for several years now at this point in time. And people view this as it doesn't affect anything really in reality to the economy now at this point in time. When it first started, it was viewed as like, it's going to cause commodities to do this. Now at this point in time, now it's going on several years. People are, as far as when I say people, I'm talking about investors, are basically just treating that conflict now like when stuff happens in the Middle East. Like stuff happens in the Middle East all the time, and they're like, life goes on. Like, oh, something happened in the Middle East. Okay. That's the way that conflict's being viewed now at this point in time. Not saying that's right. I'm just saying what the market's doing. And so, to expect the market to crash because, Russia did this, like, okay, good luck.
Being first and foremost in everybody's mind. With all that said, I mean, you have to say at some point, things can get a little dicey here, given all the geopolitical risks out there and all the other things we're going to talk about later in the show.
Yeah, let's move on then to...
And there's also a view that we're, less than 2 months away now from Trump getting in office. And there's a view that a lot of individuals have, especially a lot of investors, that Trump's going to calm things down in regards to that whole conflict. So that is something else to kind of factor in here.
This outperformance.
Yeah, the one guy didn't answer. You can say it, Tyler.
No. Wait a second. Listen to how we led the show. Before we get into it, what are your thoughts on the market?
Okay, he's a little defensive, Tyler. I'm not.
You're not defensive.
And I'm happy to talk about this because I think we're going to maybe even talk about the underperformance of semis, although maybe this is that conversation right now. So it's partially because I think we've priced in so much good news. You had a day after the day after on Nvidia. In other words, stock finally did give up a little bit of ground.
Nvidia was down today, right? Yeah, it didn't. There it is.
But I as we argued even yesterday, and I think even the 3.4% move today is something that, all things considered, the zoom into those numbers, the fact that I think they kind of downshifted successfully in terms of the guide. But software is moving because it is really seen as the next reverberation out. You throw a pebble in the water, guy, what happens?
You get ripple effects.
Okay, you get ripple effects, and that's really what I think is happening. No, but I mean,
then the ripples go away.
The ripples go away eventually, and I think at some point what we've seen other times is software has actually followed semis, and I think that's happened again. I think software, ton of upgrades this week, but we heard it from everybody, from Snowflake, even Datadog, who I think 6% of their ARR is actually an AI customer base, yet that base tripled in the last year. That's the kind of thing you do in software, and none of these valuations make sense. And we've talked about this with Palantir. I think it was 38 times forward sales, which is absurd. But the argument here is that if you're playing AI, you're playing it through the enablers, and software platforms have different ways to do it. And frankly, that's the way a lot of the consumers are reaching out, but more importantly, enterprise is happening right now. And I think it continues.
Bonawyn, thoughts on the broader market hitting new highs on the Dow, the S&P within a hair of 6,000, or pick up on Tim's thinking on the semis versus software?
So I'm going to be defensive and offensive.
Okay.
So I'm going to avoid the question first and then answer it second.
Very nice.
So in terms of the broader market, listen, I think we're in essentially an everything rally right now. Going into the Nvidia print, I think a lot of us spoke about how we were a bit concerned about that. We'd like to see it perhaps trade a little flat or perhaps just be a bit more defensive in terms of posturing before going into that print. I think that kind of explains the move that we saw post-earnings because it was yet another blowout quarter. I think questions about Blackwell supply and ability and back ordering and pull forward of ordering there. I think those concerns have been assuaged. And then in terms of the divergence between what we're seeing from SMH and I Give Up is, a lot of those names. Let's take Salesforce, for example. The question was, and this is also with some of the hyperscalers, this AI-related CapEx spend needs to be justified. That was the prevailing wisdom at the time. And these companies were coming under pressure because investors really didn't feel like they had an accurate answer to that question. You saw Salesforce trade off, I don't know what it was, 25% post-earnings. Mm-hmm. And so a lot of those names had gotten beaten up coming into the print. And so that explains a bit of it. It's essentially you have like a star player like Nvidia dragging up the rest of the balance. And so you've kind of been mired in that drag because, again, there's been...
So in regards to Nvidia stock and what's going on here, it's very, very important everybody understands this. When Nvidia makes a move, and it can happen quick, the stock could be at a total different lane. Like if we get QQQ momentum into year end, Nvidia stock could easily go from 140 to 190, 140 to 175 like that, or 140 to 190 like that. It could happen in a matter of weeks or a month and a half. Like it happens quick. Like look at this move. You went into January, beginning of January, Nvidia's, let me get rid of the Qs here and let me get rid of S&P 500. So Nvidia at this particular time, 47, right? And that's the beginning of January. By the beginning of March, 2 months later, Nvidia's 92. So we're talking about almost a double up, right? In 2 months. In 2 months, the stock almost doubled. That would be like this stock going from 140 to like, let's call it, because not quite a double, let's call it to 270 over the next 2 months, right? Right here. This is kind of, late April, stock's 75, 76. And then the stock, June, a couple months later, right, is 135. I mean, it's just insane. Almost another double up. So that's what I'm saying. Like, if you get some momentum in Nvidia stock, the stock could move, $40, $50 a share before you even got a chance to catch your breath and look at it and be like, what is going on here? So a little food for thought in regards to that.
Massive divergence between AI-related CapEx spend and then CapEx spend going forward.
Okay, next video up here. Let's react to this one.
On and leaning further into Nvidia and Tesla, Ben Snyder, Goldman Sachs senior U.S. equity strategist, joins us right here on set. Ben, welcome.
Good to be with you.
YOLO? Is this a YOLO, FOMO, frothy market to you, or is this...
Oh, man, he makes me want to shave my head again. I might have to shave it again.
What you would expect given seasonality, given the fact that we just got through a presidential election, you got a red wave, and you have earnings continuing to power higher.
I think, before the election, the outlook looked really solid. You had good earnings growth. We're forecasting 11% earnings growth for next year. You have a Fed that is in the progress of a cutting cycle. That's a good backdrop. And the real question is, how much has that changed post-election? If I look at what the market is telling us it's incrementally more confident in the growth outlook.
Okay. So what are you confident in? What would you be buying in this market right now?
Well, one thing we've been focusing on is, of course, the extremely elevated degree of concentration in the market and relatively elevated valuation multiples compared to history. But if you pair that with a pretty good fundamental backdrop, as I was just discussing, there should still be very attractive pockets of the equity market for investors to look at. And for us, one interesting and overlooked pocket is mid-cap equities. You have this big group of stocks. They trade with very large market caps, very high profitability, and most investors have completely overlooked them. And the result of that is they trade almost exactly in line with their historical average valuation multiples.
So in terms of the tech trade, obviously we got Nvidia earnings this week. That was seen as kind of a key catalyst one way or the other for the broader markets. Didn't really play out that way because even though it was a beat and raise quarter, it wasn't as strong as investors were hoping and the street was whispering. And yet we're poised for gains for the major averages. So what does that tell us about the concentration you just talked about and thus the rotation we're seeing?
I think it's very clear that the Mag 7 or the AI stocks, whatever group you want to look at, the earnings growth continues. But it's also clear that the acceleration in that growth seems to be slowing. And likewise, the beats that we're seeing every quarter, they're getting a little bit smaller every quarter. And so investors are asking themselves, what's the next part of the AI trade? And we've been focused on software. We are calling that phase 3 of the AI trade. Basically, so far, investors have been focused first on semiconductors, then on the broader infrastructure, what we call phase 2, including electrical utilities. And we think now it's time to start looking at phase 3, which is mostly the software companies that can use AI to generate revenues for themselves.
Although the move lately has been out of chips and into software. So is that story already well understood by the street?
I think it's starting to be understood. Just this week we published our quarterly analysis of position filings in the hedge fund universe. We looked at almost 800 hedge funds. And of course, we saw something we see almost every quarter, which is the Mag 7 are the most popular long positions. But what we also saw is, on average, funds shifted a little bit away from those stocks and towards software. And this was really the first quarter where we saw that move take place.
So you think there's more to go on that?
We think it's just the beginning of this trend.
We've been making jokes about the 12-month index projections. A lot of them are around 6,500 S&P. Is that sort of a standard, let's give it 10% because so much of policy right now is not clear? What's on the way?
There's certainly a lot of policy uncertainty. We're trying to work with what we have and where we have clarity. As I mentioned earlier, one place we have clarity is the health of the economy and the health of earnings growth. Even before the election, we were forecasting about 11% earnings growth for next year. That corresponds with about a 10 or 11% return. Right. That's how we got to 65.
So the question then is, what is a baseline China tariff, right? No one really knows, although some base cases are taking it to 60. Yeah?
Our base case is smaller than 60. We're assuming a 20% tariff. On the other end, we're expecting some modest tax cuts, perhaps some deregulation. When we put that all together, we think it nets out to not a major change for earnings, but of course we'll be watching the headlines like everyone else.
Well, mid-caps and small-caps have benefited as a result of the belief that there's going to be a lower tax rate domestically, right? I mean, can that continue to play out?
Yeah, mid-caps benefit from, as I said earlier, strong earnings growth. As you said, they're relatively insulated from tariffs because they tend to be more domestic-facing. And yes, they're more exposed to the U.S. economy. So if there's deregulation, tax cuts, other factors that boost U.S. growth, they should continue to outperform. But we'll have to see what policies are implemented in late January.
I mean, small caps are just in a sweet spot for really the next, I would say, 6 to 12 months. And the reason being is inflation's done. So there's no more fear around inflation and how that's going to hurt the small caps. Rates are likely going lower from here over this next year, which bodes well for small caps. Additionally, Trump coming in office, small caps did tremendous under Trump, from basically when he got in office until Rona happened, right? And so from that viewpoint, a lot of people want to own small caps. And also small caps have not done anything for years. I went ahead and took a look at this recently. I think it was the video I did on the main channel a couple days ago. And what I showed is that the Russell 2000 versus inflation over the last few years, and the Russell's real return is like negative 13% over the past 3 years. That's what it was. The Russell's real return over the past 3 years was like negative 13%. Like if you look at it, it's basically like flatline, but we've basically had 13% of inflation in general on everything, right, over the past 3 years. And so, it honestly feels like a lot more than 13% when you really add up the real numbers. So the real number is like, it might be a lot worse than negative 13%. But the moral of the story is the Russell hasn't done anything for years. So there's just so many tailwinds behind this Russell 2000 for the next 6 to 12 months. And then a lot of people are kind of also burnt out of just buying the big techs, which obviously we've seen recently because all those big techs are kind of just floundering around. And so they're looking like, what else did I invest in? Oh, small cap stocks. And the more momentum that will build in the Russell 2000, the more momentum that will build in the Russell 2000, because the more that baby starts to roll and small caps start to roll, the more investors are going to be looking like, dang, that's where the money's being made? Okay, I got to flood over there. I got to flood over there. Oh, who cares about Nvidia stock anymore? I'm in this small cap that's moving huge. Honest is a great example. HNST. Honest is outperforming everybody. They're destroying Nvidia's returns. They're destroying Palantir's returns. They're destroying everybody's returns really out there, right? And it's just some small cap company. And so the more stories you start to see like Honest, the more people are going to be like, that's where I need to be, because that's where I can double my money over the next year, or the next 6 months, or next 3 months, or whatever, versus these other big companies that don't have as good of growth, or whatever the situation is, right? So that's the Russell just has a lot of tailwinds over the short term.
Wait and see at this point, isn't it?
I think that's right.
Yeah.
The other thing, a note from you guys in the last few weeks, which we talked a lot about, was the longer term look at maybe suppressed returns over a decade relative to prior decades because of that concentration, and Costin's talked about that. Has that view evolved in recent weeks at all?
When we're looking out over 10 years plus, it shouldn't change very much week to week. It hasn't changed very much week to week for us. Really, we're trying to think about the world in two different investment horizons, right? The first is, what does growth look like? What does policy look like? What does that mean for investors in 2025? When I look out 10 years, it's very hard to know what the next administration will even be.
Yeah,
so we're really thinking more about where are valuations today, where is concentration today, and it's hard to argue with the fact that those are very high compared to history.
True. Alrighty, guys. Appreciate you joining me as always. Once again, we're only a few days away. What are we? 3 days away? 4 days away? Something like that. 5 days away from the Black Friday sale. So pin comment down there for access to the Black Friday sale if you want access on that one-day deal, November 29th. Once again, you might want to put in your phone number so you can have it text over that deal instead of just via email. But do whatever you want, okay? But once again, it's one-day sale. When it's over, it's all over. Much love and have a great day.